Okay, so Ron's question, it looks like, he says, I created a diagonal spread on MKE, but lost IV on all four options for a loss. Why? It's an earnings play. Oh, great question, Ron. I had something similar to this that came up. I forget the gentleman's name. Was it Gustavo? I don't remember. But I was, if we had time, I was going to look at it. But hey, we're here, so I'm going to look at it. I don't remember the exact strikes, but here's what we had. I'm using MU because this was Gustavo's example, Ron, and I think it's going to relate to what you're looking at. And then we'll take a look at MKE specifically, kind of. Yeah, April 1st. I'm going to sell a 75 put and sell, it's at 3 points down. That's about 3. Yeah, 82. Why not? Yeah, I should do the 81, but I'm going to do the 82. And we're going to go out to May. I think it was May, but I don't remember. And we're going to buy, what did I do? I'm sorry, let me take a look here. I'm sorry, folks. Good. 70 put and 90. We'll do 90. Oh, no, that's too far. Well, that doesn't matter. Let me just see if I even get this right, Ron. Nope. That's not really what I wanted. It's close though, but let me change the call. I don't think I'm going to get where the year position probably looked like at first. I should probably use April. In any case, I did that 82, right? I'm sorry for scrolling, folks. 85. Okay, we'll try to keep it close. 85. Anyway, this isn't going to look much better, but I just want to put this in. All right. That's better. All right, so this is similar to a position. Now, investors have been trying to use these double diagonal positions around earnings, and it's not something I highly recommend because of the conversation that we had earlier with Michael related to the poor man's covered call. What affects the expected outcome of this position is the implied volatility. The position that Gustavo gave me actually was more of a peaked. Let me change color there. Let me get a better color. I need something deeper. I want to get the deep blue here so it'll show up better on that green background. Here we go. The one Gustavo showed me was something that did this. I don't know if it's because he was closer to the strike prices. And then the profit and loss at halfway was something along the lines of this. I know that looks strange. And it's similar to this position that I have here. And he said, Mike, how is this possible? I'm seeing a 220% potential max return on these peaks, but even if the stock is trading between 71 and 89, I'm making high profits of $100 or $200 on a $200 investment or less. You know, I'm seeing 70, 80, 90% profits anywhere in this time period. And how can I go wrong on this trade? This, again, is based on the theoretical prices of the long options and the short options. If the stock stays within its range and the implied volatilities remain the same. This is what we saw earlier. Earnings were coming up. This is what I discussed for Gustavo. Earnings are coming up. And yes, an implied volatility decrease, which won't happen until after the earnings on 3/29. But the low range of implied volatility before the flux on earnings on these MU options was 0.3 to 0.35. Oh, wait. Let me do this first. Let me put those back to where they were. I'm sorry. I want to show you something first here. All right, so there we go. And you did mention it's an earnings play, so Ron, this is what happened to you. If the stock even moves up to $83 on the 30th, the day after expiration, I'm still looking at a potential profit of $198.50. You know, 83. Let's go to 85. Above the strike prices here on this double diagonal. There you go, 143.50. All right. So, you know, still at a profit here. Now we're in the money, but we're getting closer. We're still at a profit of 143. We only paid 213. But after 329, all of these are going to collapse. As soon as the earnings are announced, these are going to go back potentially to their low range. At first, they might fluctuate a little bit if the stock drops 8%, if the stock drops 9%, if the stock drops 10%. But again, what are your real value? Your real value is here. You've already collected this premium. You're just hoping for a low buyback cost on these options. But here's the big problem. I dropped these all down to 0.3, where even if the stock was at 85 at $143 profit, now when it goes back to normal implied volatility, I'm at a loss of 120. Once that event happens, and even if we were at 80, closer to the profit range, let's say 82, let's say the peak of 82, and the implied volatility of these options go back to normal, you're still at a small loss of $12. That profit and loss chart you see, if you're playing a diagonal or a double diagonal on earnings, is only based on if the implied volatilities stay the same. And they're going to experience implied volatility crush, just like buying a straddle or buying a stranglewood. Is that supposed to work in favor for the options that you sold? Yes, but you'd already taken account to that with the price, with your initial net debit. What's the concern now is how badly do these long options deteriorate, with or without a flux in the stock price, because the implied volatility is going to get crushed. This is what I had to explain to Gustavo about why the spread he was looking at was not so good to be true, was not too good to be true as he thought it was, because this profit and loss chart after expiration will not be the same, because the implied volatilities will get crushed. The expected value you have on your long options with that higher pre-earnings implied volatility is going to collapse. And this is dangerous. This is why you have to be careful with these positions. Okay. You lost IV on all four options. Yeah. And that's the crush. Now, not sure, Ron, if you're saying that the implied volatility was decreasing as you were going into earnings date, Ron. I'm sorry. Sometimes not all stocks will see the implied volatility increase going into earnings. You normally do. Some, it's only a small move of, say, 0.25 to 0.27 or 0.26. We saw MU in the last 7 days go from 0.6 to 0.8 in the last 10 days leading up to its earnings date coming in on 3/29. This is what you're going to experience with these double diagonal plays going through earnings. That's what's going to happen. Even if your stock again fell 7, 8, 9% or gapped up 7, 8, 9%, the implied volatility is going to go back to its normal range. And it might even go all the way back to its lowest range, to 0.30, 0.32, 0.33. And that's what causes the loss. See here, we're supposed to be at our peak profit at $82 the day after earnings, 1 day before expiration, and we're still at a loss. This is a small loss in this case, but if it stayed even right in the middle, again, we saw what that loss was. That's what happened, Ron. The implied volatilities have to adjust. The event is done. The known event that was causing the increase in implied volatility has now passed. Implied volatility collapses. These types of calendar spreads and double diagonals around earnings, you have to be careful of a strong implied volatility crush, and you have to remember that the profit and loss chart you saw, by the way, the graph that Gustavo sent me was similar to this, and when I graphed it on a MU on PowerOptions, my graph looks similar to his, but his was from his broker. I can't remember if it was Thinkorswim or Tasty Trade, but that's how we have to calculate these double diagonals. They're based on the theoretical prices of what the long options would be worth at short option expiration. You have to know what that implied volatility is. You have to know, and you can see it here. Let's go over to option research. This is for the 70 put. Okay, so this one wasn't as low. It's 0.40 to 0.6293. So it's possible that this would only drop to 0.40. But right now, where is it? 0.52. That's going to cause a significant change in expected value in the pricing of this option with that volatility collapse. What you want to do is when you're trying to find a position, when you're trying to find a position like that, did it take me off of the page? No, it didn't. I'm sorry, guys. When you're evaluating a position like this for earnings, you want to scroll down and see where your implied volatilities are. Then what you want to do is look at each individual one, or if you're looking on the option chain, you can have it you can see it there as well. What you want to do, option research. You want to look for the total implied volatility range, the lowest value, and then when you go back to that profit and loss chart, you want to substitute those numbers back in to see what your expected gain or loss would be if the stock was trading at a certain price with that volatility collapse. You have to prepare for that. That's what happened to Iran, and I'm sorry it happened, but that's what happened. The implied volatility will always collapse after earnings, all 4 options. And it works in your favor in the sells, but that was already taken into account with your initial net debit. It's going to crush the expected value of your longs. And that's just the nature of trading. That's why trading buying straddles and strangles around earnings is sometimes very, very difficult, because you can overpay into the positions. You can see the movement that you want, but you're still not potentially going to profit if the volatility flux was way too high and the implied volatility crush was way too high. So Ron, I'm sorry to hear about that, and I hope that answers your question. I hope it gives you that insight of what you should look for doing these double diagonals going forward, with the concern of implied volatility and expecting an implied volatility crush, how to now see what the expectation of the volatility lowest value might be, incorporate that into the profit and loss chart, sorry folks, so that you can see in that case what your worst case scenario might be, and is it worth it to take that chance with that kind of earnings play.